Hey everybody, the reason I decided to make this video is I had a lot of people asking me specifically about wick over wick levels. They watch the daily market commentary and they see some of the levels that I highlight and they ask, why do I select those levels? What's my purpose? What's my reason behind there? So I thought I would do a quick little introduction into what wick over wick levels are. What's the psychology of the buyers and sellers behind them? Why do we use them? And then show you kind of what to look for. It's not a whole lot to look for, but I think it's a pretty powerful tool and something you might want to use in your trading. So I'm going to show a little bit of a presentation with some introductory stuff, and then we'll go in and look at a chart example to see kind of what one looks like. So I'll try to keep this video fairly short, high level. Do me a favor, in the comment section down below, if you have ever used wick over wick levels, leave me a comment. If you like this video, please give a thumbs up. Those kind of things always help, lets the computers know that people are watching, and share this video with others if you think it would be useful. All right, let's go ahead and dive in. So when we talk about the power of trading wick over wick levels, what we're really trying to do is we're trying to get into areas of trading that not everybody else is looking at. And what I want to do, today is to talk about what are wicks. And I think we want to talk about what a wick is in general, because a wick is a very important part of the candlestick. Why are those wicks so important to trading? What do they mean? And then we're going to discuss this thing called the law of diffusion of innovation. And what does the law of diffusion of innovation mean in the markets? So understanding kind of where they come from and what the psychology is. And then how can I use wicks to find these hidden levels? That's what we're going to do. So when we think about a chart, right? This is charting 101. A chart is nothing more than a graphical representation of a change in price over a given period of time. As time goes on, price changes, and a chart just shows us a graphical picture of the change in price over that given unit of time. Well, specifically, a candlestick chart shows us what's called the time and sales report in a graphical formation. The time and sales report, it's an actual record of trades, right? That time and sales report's an actual record of trades, and it shows the time the trade occurred. So we know what time every single trade occurred. We know the price that the trade occurred, whether in this example anywhere as low as 59.35 to as high as 59.65, right? We know the size of the trade as far as the number of shares or the blocks that were traded, and then based on the color, we know if it occurred at the bid or at the ask. So the bottom two aren't really as relevant for this discussion. We're going to focus mostly on the time of the trade and the price that the trade occurred. So how is a candlestick formed? Well, let's first talk about the candlestick itself. There are four parts to the candlestick, right? There's the open, close, high, and low, and when I'm looking at a candlestick, the body is the difference between the open and the close. The wicks are those high and low differences, right? So when I'm looking at the candlestick, the body is going to be the area between the open and the close. The wick or the tail is the area above or below. Now, very simply put, in a green candlestick, the close is higher than the open. Right? In a green candlestick, the close is higher than the open. So any wick above the green candlestick means that price got that high and then came back down, right? Any wick above a candlestick tells me that price got as high as a certain level and then had to come back down. Any wick below that candlestick means that we got below either the open or the close and then had to come back up. So long lower wicks are oftentimes going to be very bullish signals. Long upper wicks would oftentimes be very bearish signals, irregardless of the color of the candlestick itself. The body of the candlestick, in my mind, is not as important as the wick or the tail. So let's really look at the formation of a candlestick and why that's important. So I took a chart that has a stock that has fairly low volume here so that we could look at a full 5-minute period. So this particular stock, we're going to look at a 5-minute candlestick. And I highlighted one candlestick in particular that we could take a look at. Now this candlestick it's a green candlestick, which means we opened on the bottom and then closed at the top, and it's got an upper wick. Well, this candlestick relates to these trades that are highlighted in the time and sales report. Now, when I look at this time and sales report, all I've got to do is look at the price, right? Well, the easiest ones to find are my open and close. The opening price is the first trade that occurred in that 5-minute period. The closing price is the last trade that occurred in that 5-minute period. So the open and the close are the easiest ones to see. Now, as I go through the list, I can see what's my highest price. Well, my highest price is this one here, 59.525, as my highest price. That means we got one trade up at that level, and then everything else came back down below. And actually, I put the arrow in the wrong spot. It should be 59.55 now that I'm looking at it. So the highest price was 59.55. So we went all the way up to 59.55 and then came back down. Now, where's the lowest price? Well, in this case, the lowest price was the price at which we opened. That's why there's no lower wick. So the candlestick shows me where price has gone in the past. And when I'm looking at a candlestick, it's important to know why we use these candlesticks. Because if we had gotten, if our high in this case was 59.70, then we know that up at that 59.70, price would have still come back down to 59.50, which was our closing price. So there had to be some sellers up there. So the importance of candlesticks is to see buyers and sellers inside of the time and sales without having to use the time and sales report. Now, why does this get so valuable in our trading? Well, this gets valuable in our trading because when I'm looking at, say, a 10-minute chart, right? In a 10-minute chart, that's the same as one 60-minute chart, right? So looking at this 60-minute chart, we see the open, close, high, and low. And there's 6 10-minute candlesticks inside of one 60-minute candlestick. Now, looking at these 10-minute candlesticks, it's pretty obvious to see that we're fairly bearish, right? And this 60-minute chart enhances that bearishness by the fact that we got as high as the top of that candlestick. And so we always look at this piece because we got to start to think about what moves markets. And this is where we talk about this diffusion of innovation. See, when I go back and I look at this candlestick, what caused price to start going down in this instance? Well, it was the fact that there were sellers, right? It was the fact that there were sellers. So there had to be a seller that had enough money to drive this price down. A seller had to exist with enough capital to drive this price down. So I want to talk a little bit about this concept of diffusion of innovation. So this is actually not a trading concept. This is a concept that is prevalent. It's a marketing concept. There's a lot of places that you can read about this. I actually read about it in the book Start With Why by Simon Sinek, and he talks about this. And he said that if we think about a standard bell curve of normal distribution, he says that when any new product is released, there's 2.5% of the people that get involved are the innovators, right? They're the ones that have to be first in line to buy any new product. They're the ones that are first in line they're the ones camping outside of the Apple store when the new iPhone is released, right? The next 13.5% are what are called the early adopters. When the early adopters kick in, that's when you oftentimes will see that it starts to gain a lot more notoriety, right? The innovators oftentimes are they'll innovate. They just have to be first, and they only represent about 2.5% of the population. But the early adopters, they're the ones that they're willing to pay a little bit more for technology. They're willing to get in a little bit earlier than everybody else, and that's really what's called the tipping point. So until you get that first 16% or so, you don't really have a tipping point. It's not until the early majority hits that you really start to see big mass market acceptance and mass market movement, right? Early majority kicks in, you see mass market acceptance and mass market movement. Now, then eventually the late majority comes in, and they come on board, and the final 16% are the laggards, right? The laggards, some of the laggards still probably use a DVD player because they've not decided to slide over to streaming, and they even skipped through Blu-ray. The point there being is that the laggards will lag behind because they don't see a reason to get on board, but eventually they will, but it's going to always be late. So let's talk about this from a market perspective, right? The innovators and the early adopters oftentimes aren't enough to cause markets to move, yet when the early majority and the late majority get in, they look back and say, I wish I would have been an early adopter, right? That's very common. So let's look at a stock example. Now, this is a stock of NVIDIA. This is a little bit of an older example, and I bring out the older example specifically because I think that the older example works really well. Now, this is a weekly chart of NVIDIA, but if I look at this, think of it like this. The innovators were the ones that were getting in the very, very beginning before anybody else was. They wanted to be the first on board. The early adopters come in next, and that's really what starts the big price movement, right? When the early adopters start jumping in, then we see the price movement. Now, as the early majority slides in, that's the tipping point. The tipping point happens when the early majority gets in, and then eventually the late majority gets in. Now, take a look at the volume down at the bottom. You notice that the early majorities where the volume is really increased, because that's what caused that price to continue to move. So this is a macro scale, right? This is looking at a macro scale, a bigger time period. But think about on a smaller scale, right? Think about on a bit of a smaller scale. It happens on small time frames as well. So look at this 60-minute chart. So on this 60-minute chart, who had the money to start this market dropping? Well, oftentimes you're going to see that the markets will start to drop in this case because the innovators and the early majority, the innovators and the early adopters jump in first, right? Well, when those innovators and early adopters jump in first, there's still plenty of people to transact with. Then the early majority jumps in and the stock really falls because the early majority of sellers get in and the stock starts to make a big move down. Well, what we look for is the area just where it started to really make its move. We'll call it the tipping point. I want to look for the tipping point area. And the tipping point area is oftentimes going to be a wick over, it's going to represent itself as a wick over wick area below a pivot high. So if I'm looking for a potential selling opportunity, it's going to be very oftentimes be at a wick over wick level below a pivot high, which is really when that tipping point occurs. And we start to see that the early majority has come in and started to move price. Well, that 60-minute chart, really, if I looked at it on a 15-minute chart, would look a lot like this, right? It would look a lot like this, where the early majority starts to come in and move things at the point where we see the parabolic move down. And so the area that I've highlighted as the wick over wick level on the 60-minute chart is shown very easily as basically a drop base and then a strong drop on a 15-minute chart. So oftentimes your wick over wick levels are going to be drop base drops or rally base rallies on smaller time periods. So let's go look at an example inside of a price chart. So here's a price chart of crude oil. Now, in this time, crude oil is trading at about 53.38. We're seeing that crude oil has come down off of a little bit of a supply area up above. We've got a pretty strong and decent move down inside of crude oil. Now, if I go to a bigger picture chart, let's say the 4-hour time period, we see that crude oil is actually in a little bit of an upward trend, right? And I look at the 4-hour to give me my trend determination, and I see that I have a swing high right here. My last two swing highs are higher. My last two swing lows are higher. So I'm in an upward trend environment inside of this position. So then let's go to the 1 hour to look for a potential entry. Well, as I go to the 1 hour to look for a potential entry, my eye is immediately drawn to this level right here, which is this wick over wick area. And I'll zoom in on that a little bit so it's a little bit cleaner to see, this wick over wick area. Now, a couple of my rules on a wick over wick, and I call them wick over wick because they essentially are wicks of the same size. And what I'm especially looking for in this instance is, let me really zoom in, that the wick of the first candlestick, which in this case is my 11 o'clock candlestick, overlaps the body of the 12 o'clock candlestick. And the 12 o'clock candlestick wick overlaps the body of the 11 o'clock candlestick. So what I do is wrap my lines around both wicks. So both of those wicks then become my zone. I wrap my line around those two wicks, and that becomes a wick over wick area. That's what I refer to them as. Now, if we think about it, that the price movement started down here. The price movement started down here. This was what started the price movement. This is a pivot low. Now, it may not look like a pivot low to the uninitiated eye, but this is a pivot low because it's a long lower wick with price then rallying higher. So I oftentimes will look for pivot lows followed by a wick over wick area of demand, and then when the when the early majority jumps in, now we start to get our tipping point, and price really made a nice move. Now, this is on a much smaller time period, but this is the level that I will look at as a potential demand zone when price returns to here, because it'll allow me to rejoin my big picture trend as well as get in before everybody else is. And oftentimes you'll see a lot of traders and investors, they'll draw their lines around the actual pivot, or they'll look a bit lower, and they'll just miss on getting filled on the trade. And by feeling comfortable and confident with wick over wick levels, you will identify these a lot more clearly, and you will be able to get in a little bit earlier. So hopefully this answers some questions you might have over wick levels. If you have any questions, always send us an email, support@tradersarmy.com. I hope you guys have an amazing trading day, and I will talk to you soon. See ya.